Welcome back to Smart Stock Sam, the channel where we strip away the Wall Street noise and give you the cold, hard data that actually moves markets. Today, we are diving deep into one of the most polarizing, most debated, most electrifying stocks in the entire fintech space right now, SoFi Technologies. A company posting record-shattering earnings, a 45% jump in market share growth, and a user base that has exploded to nearly 15 million members. Yet its stock was recently trading down over 40% from its all-time highs. That contradiction right there, that is exactly why we are here today. By the time this video is done, you are going to walk away with a complete picture. The technical setup, the fundamental firepower, the explosive catalysts, and the very real risks that Wall Street is weaponizing against this stock. We are going to cover the massive double-bottom reversal on the charts, the jaw-dropping Q1 earnings that left analysts scrambling, SoFi's aggressive infrastructure acquisitions that most retail investors are completely sleeping on, the brand-new SoFiUSD stablecoin that is rewriting the rulebook for what a bank can even be, the short squeeze setup that is quietly building pressure like a coiled spring, and the exact price levels you need to be watching this week. So grab your notepad, hit that subscribe button if you are new here, because Smart Stock Sam is about to break this all the way down. Now, before we go any further, could a stock with this kind of fundamental momentum actually be the most undervalued fintech play of 2026? That is the question, and the answer might genuinely surprise you. Let us start with the charts, because the price action right now is telling us something very important. We are officially looking at a textbook double-bottom reversal pattern, and if you have been around the markets long enough, you know exactly what that means. For months, SoFi bled out steadily, cascading all the way down from its peak of $32.73. The selling pressure was relentless. But then something remarkable happened. The stock hit a concrete floor at $15 even. Not once, twice. It tested that exact level on two separate occasions, and both times the sellers ran dry. The buyers stepped in with conviction and refused to let it go lower. And then on May 29th, SoFi exploded. The stock closed at $18.22, locking in a massive 7.37% daily gain. But here is what matters even more than the price. It is the volume behind that move. Over 150 million shares traded hands in a single session. 150 million. That is not retail traders punching buttons on their lunch break. That is institutional capital. That is the big money quietly deciding the bottom is in, and that decision was driven by a powerful convergence of earnings beats, stablecoin headlines, and major infrastructure buyouts. The chart is speaking, and right now it is screaming. But here is a question worth sitting with. What are the chances a stock with this kind of institutional accumulation just quietly fades away without ever triggering that squeeze? Pretty much zero, and the fundamentals make that case even stronger. So let us dig into the actual numbers, because SoFi's Q1 results were not just good, they were Wall Street embarrassing good. Analysts had penciled in $1.05 billion in revenue. SoFi came in at $1.1 billion, representing a staggering 41 to 43% year-over-year growth. Think about that for a second. A bank, not a software company, not a social media platform, a bank growing revenue at over 40% in one of the tightest macroeconomic environments in recent memory. That is not normal. That is exceptional. Earnings per share doubled year-over-year, coming in at 12 cents. They originated a record $12.2 billion in loans, and their member base grew 35% to a whopping 14.7 million members. These are not vanity metrics padded for optics. These are real, monetizable customers being pulled deeper into the SoFi ecosystem at a rate that most financial institutions would give anything to replicate. The revenue engine is firing on all cylinders. But here is what makes SoFi genuinely fascinating. Consumer lending is not even their endgame, not by a long shot. Behind the headlines, SoFi has been quietly executing one of the most ambitious infrastructure expansions in the fintech space, and the overwhelming majority of retail investors are completely missing it. They recently acquired Peach, a cloud-native lending technology platform that currently manages over $2 billion in active loans. This is not a flashy consumer app. This is institutional plumbing, the kind of back-end infrastructure that other banks and lenders desperately need. On top of that, SoFi scooped up the United Kingdom-based fintech assets of PrimaryBid, expanding retail investor access to new share offerings in a way that has never been done before at this scale. Now, here is why this matters strategically. Both of these acquisitions are being fed directly into SoFi Technology Solutions, the business segment that most people gloss over when they look at this company. The entire strategic vision here is a fundamental transformation of SoFi's revenue model, from a capital-heavy bank that absorbs credit risk on its own balance sheet to a capital-light, high-margin technology platform that powers other financial institutions. That shift, if fully executed, changes the valuation conversation entirely. Software-style margins on a banking-scale revenue base is an entirely different business than what most people think they are buying when they buy SoFi stock. And speaking of transformation, nothing signals that shift more powerfully than what SoFi just did in the crypto and digital asset space. Enter SoFiUSD. In a move that genuinely stunned the traditional banking sector, SoFi just launched the very first stablecoin ever issued by a United States national bank on a consumer application. Read that sentence again, the first ever. We are talking about a bridge between traditional finance and decentralized finance, built and backed by a fully regulated national bank. SoFiUSD operates on both the Ethereum and Solana blockchains, and it is backed exactly one-to-one by US dollars. This is not speculative crypto gambling. This is regulated tokenized liquidity with the full backstop of a national bank charter behind it. And SoFi is not stopping there. They are already planning tokenized deposits and have a major settlement integration mapped out in partnership with MasterCard. What does that partnership unlock? It means SoFi members will have instant access to digital assets with the security of FDIC-insured banking behind them. That is an unprecedented moat. No pure crypto exchange can offer the safety net. No traditional bank has moved this fast or this boldly. SoFi is occupying a lane that did not exist 12 months ago, and they are the only ones in it. Could SoFiUSD become the stablecoin infrastructure that dozens of other financial institutions eventually build on? If that happens, and the MasterCard partnership suggests it is a real possibility, the valuation ceiling on this stock moves dramatically higher. Now, none of this matters unless we are honest about the risks. And believe me, the bear case on SoFi is loud, it is aggressive, and it deserves a serious look. Welcome to the wall of worry. Let us walk through it piece by piece. First, we have the short report. Muddy Waters Research came out swinging with serious allegations of accounting manipulation, claiming that SoFi is deliberately obfuscating its loan charge-off rates, using off-balance sheet tricks designed to make credit quality look better than it actually is. That kind of allegation, from a credible short seller, does not just create noise. It creates lasting uncertainty, and the market priced that uncertainty in immediately. Then you have the insider selling. The chief technology officer and executive vice president combined to sell nearly 250,000 shares over the last 6 months. Timing matters here. When executives sell into a period where the stock is already under pressure from a short report, it reads as confirmation of the bear thesis in the eyes of the market, regardless of whether those sales were pre-planned. And then there are the analyst target cuts. Truist slashed their price target to $17. Morgan Stanley cut theirs to $16. The reason? Management left their full-year 2026 guidance completely unchanged, building in 0 Federal Reserve rate cuts for the entire year. In an environment where the market is desperate for rate relief, assuming none of it materializes is an aggressive stance, and the street punished SoFi for it. The combination of all three of these factors, The short report, the insider selling, and the analyst downgrades created a perfect bearish storm that drove the stock toward that $15 floor. But here is the thing about storms. They create buying opportunities for the people with enough conviction to step in while everyone else is running for cover. And one person stepped in with about as much conviction as you can possibly display. CEO Anthony Noto. While the financial media was amplifying the Muddy Waters report and the analyst downgrades, Noto was quietly and aggressively accumulating shares on the open market. 116,323 shares, purchased between $15.73 and $17.88 per share. His own cash, his own money, his own conviction that the bear thesis is wrong. You simply do not spend $1 million+ of your personal capital buying your own company's stock if you genuinely believe the accounting is fraudulent. That action alone should give pause to anyone leaning too hard on the Muddy Waters narrative. And Noto is far from alone in that conviction. Institutional ownership of SoFi now sits at a remarkable 63.02%. Vanguard, BlackRock, Jane Street, the heavyweights, are sitting on over 808 million shares and showing no signs of reducing their positions. When you run a long-term fair value model on SoFi's current margin expansion trajectory, the numbers suggest a target somewhere between $27 and $37 per share. That is not a moonshot guess. That is where the math lands if SoFi simply continues executing at its current pace. So what we have here is the ultimate sentiment divide, a tug-of-war between two completely different realities playing out in real time. The bull case: rapid fundamental scaling, unprecedented loan origination records, aggressive CEO insider buying, 63% institutional ownership, and a long-term valuation that implies the stock could double from current levels. The bear case: accusations of financial engineering, executive share sales, a macro environment with zero rate cuts baked in, and a wave of analyst target reductions. When bulls and bears are this deeply entrenched, this furiously opposed, the stock becomes a pressure cooker, and pressure cookers do not simmer forever. Eventually, one side breaks, and when that happens in a stock with this much institutional positioning, the price movement is not gradual. It is violent, and the technical picture right now suggests very strongly which side is starting to crack. SoFi has officially entered strong buy territory by nearly every technical measure. The price action just sliced cleanly through its 50-day moving average at $16.27. It then pushed straight through the critical 200-day moving average at $16.65. Crossing both of those levels on massive volume is not a coincidence. That is a confirmed momentum shift. The relative strength index is reading 73.43. Yes, that is technically in overbought territory, but here is something veteran traders know well. In momentum-driven stocks with real institutional buying pressure behind them, overbought conditions can persist far longer than most people expect. The MACD is confirming the breakout with a reading of 0.63 solidly in bullish territory. Every major technical indicator is pointing in the same direction, and that direction is up. But what really makes this setup extraordinary, what transforms it from a good trade into a potentially explosive one, is the short interest data. Right now, an incredible 13.70% of SoFi's total float is sold short. That works out to approximately 173 million shares with a bet that this stock goes lower. The days to cover ratio sits at 2.23, meaning short sellers need over 2 full days of average trading volume just to exit their positions in an orderly fashion. And here is where it gets even more interesting. Nearly 43% of the short volume is happening off-exchange in dark pools. That hidden activity suggests some sophisticated players are building or maintaining short positions quietly away from public order books. Now here is what that means for the bullish setup. The borrow fee on SoFi shares is relatively low right now, somewhere between 0.27 and 0.31% annually. That tells us short sellers are not panicking yet. They are uncomfortable, but they have not broken. If this stock pushes just a few more dollars higher, say above $19 or $20, those 173 million short shares are going to be squeezed. The math is simple and brutal. They bought short, the stock went up, and eventually they have to buy back to cover their losses. 173 million forced buyers, all hitting the same market at the same time, creates an absolute tidal wave of upside demand. And the options market is already positioning for exactly that scenario. Welcome to what is shaping up to be a fascinating options battlefield in the near term. On May 28th alone, over 524,000 contracts were traded on SoFi, and an extraordinary 75% of that volume was concentrated in call options. 3 out of every 4 contracts are betting on upside. The market is not ambiguous about its directional lean. On the downside, put support is clustered heavily around $15.50 and $16.50. Those levels act as a floor cushion. But the real gravitational pull is above. There is a massive wall of open interest sitting at the $17.50 strike with nearly 18,000 contracts, and the $18 strike with nearly 17,000 contracts. Market makers who sold those calls are now short gamma, which means as the stock rises toward and through those strikes, they are forced to buy underlying shares to hedge their exposure. That buying creates more upside price pressure, which forces more hedging, which creates more buying. The feedback loop builds on itself. This is the fundamental versus technical radar, and both sides are flashing the same signal. On the short-term technical side, you have an $18 gamma squeeze already in motion. On the long-term fundamental side, you have a company sitting on $40.2 billion in consumer deposits with a technology platform that is adding institutional clients and a stablecoin product that has no direct competitor in the regulated banking space. The technology platform revenue did take a modest hit last quarter, and that is worth watching carefully going forward. But the deposit growth trajectory and the SoFiUSD adoption rate provide a fundamental floor that supports this entire technical setup. So here is the asymmetric breakout setup for the near term, and this is what you need to watch closely. Your entry zone. You are looking for either a confirmed daily close above $18.50 to $18.60 resistance, that confirms the breakout, or a shallow pullback that finds support exactly at the $17.50 option support level. That pullback entry gives you better risk management. Your support levels, the hard floor sits at $16.50, protected by both the 200-day moving average and a dense cluster of put options. The ultimate disaster scenario support remains at $15 even, the proven double bottom level. Your resistance, the immediate ceiling, is $18.59. If the stock breaks above that cleanly and holds, the path to $19.75 opens up. Your target, based on the measured move of the double bottom pattern, combined with the option's gamma squeeze mechanics, the expected price target lands at the psychologically important $20 to $21 range. The risk to reward on this setup is highly favorable, which is exactly what you want before putting capital to work. But catching this short-term trade is only one piece of a much bigger picture. What SoFi is building underneath all of this volatility is something far more significant than any individual price target. They are building a financial super app, a fully integrated ecosystem designed to make switching away from SoFi progressively harder with every product you adopt. Think about how the flywheel spins. They hook you with competitive lending rates. They deepen the relationship with their investment and crypto offerings, including SoFiUSD. They power the entire back-end infrastructure through SoFi Technology Solutions, now turbocharged by the Peach acquisition, and they expand your wealth-building opportunities through equity access and the primary bid platform. Every single product feeds into a centralized, sticky core. The switching costs compound over time. The revenue per member grows as adoption deepens. This is the architecture of a business that is not just surviving in a competitive fintech landscape, it is actively rewriting the rules of what a digital bank can be. Could SoFi realistically be the first company to build a fully integrated bridge between traditional banking and decentralized finance at consumer scale? If they pull it off, we are not talking about a $20 stock. We are talking about something far more interesting. Now, before we wrap up, Smart Stock Sam is required to remind you that nothing in this video is financial advice. I am not a licensed financial advisor. Everything discussed here is for educational and informational purposes only. Stock investing involves substantial risk, including the potential loss of your entire investment. Past performance is never a guarantee of future results. Always do your own research. Consult with a qualified financial professional before making any investment decisions, and never invest money you cannot afford to lose. Markets are unpredictable, short reports can be accurate, and even the strongest technical setups fail. Manage your risk accordingly. Now, to summarize everything we covered today, this is the SoFi story in 3 clear pillars. Pillar 1. Fundamental acceleration. Despite a challenging macroeconomic backdrop, SoFi is scaling at a pace that most banks could only dream of. 41% revenue growth, record loan originations, and a member base approaching 15 million. Pillar 2. Narrative defiance. Wall Street tried to break this stock with short reports and analyst downgrades, but 63% institutional ownership and a CEO buying over $1 million of stock with his own money directly challenge and undermine that bear thesis. Pillar 3. The squeeze catalyst. The convergence of 13.7% short interest and overwhelmingly bullish call positioning creates a high probability setup for a push toward $20 to $21 in the near term. SoFi is not just surviving the pressure, it is building something genuinely new, and the market has not fully priced that in yet. Now here is the question I want you to answer in the comments below, and I want you to think carefully before you respond. Do you believe SoFi's stablecoin and technology platform pivot is enough to justify a premium valuation, or does the Muddy Waters accounting concern fundamentally change the risk profile for you? Drop your honest take below, because the discussion in this comment section is always where the best insights come from. If this breakdown gave you value today, please hit the like button right now. It genuinely helps more people find this content and keeps Smart Stock Sam growing. Subscribe if you are not already part of the community, because we do these deep dives every single week. And if you really want to support the channel and keep this level of research coming, you can send a super thanks right here on YouTube using the support button below this video. Every single one of those goes directly into making this content better, deeper, and more valuable for all of you. Stay sharp, stay patient, and I will see you in the next update.